Today we look into what is an economic bubble. In simple, a bubble is a situation where the price of an asset or even total market is overinflated or overvalued. The term bubble originated from the 18th century after the British South Sea bubble. It was used as a term to describe the inflated and fragile prices. But what causes them? A major factor is investor psychology. Behavioral biases such as FOMO and overconfidence often result in people overbuying assets. This causes asset prices to rise higher than their fundamental value would suggest, as there is heavy buying pressure. Another cause is the misuse of monetary policy. Keeping interest rates low allows investors to borrow at low cost and invest more into an asset, known as leverage. On top of this, quantitative easing, or when the government injects money into the economy, can further inflate prices. Innovation and structural changes can also result in investors flocking to buy the latest craze, pushing prices up higher than they should be. So what are the stages of a bubble? 1. The catalyst. This could be an innovation or trend that excites investors. 2. The boom, where prices really start to take off. 3. Depart from reality. This is where the wider market and retail investors get involved and prices go beyond logic. 4. The peak. Prices continue to rise and reach their max point. 5. The crash. The bubble bursts and prices fall off a cliff. A clear example of this was the dot-com bubble in 2000, which we see here in the Nasdaq index. As you can see, the 5 stages of the bubble were present as the growth of the internet took the investment world by storm. Bubbles can have both massive upside and downside dependent on timing. Good investors, known as the smart money, get in early and sell near the top, whereas worse investors will buy near its peak and make huge losses as the markets crash. As the term bubble suggests, they are easy to burst. One negative piece of press or a comment by a respected investor can be all it takes. Let's look into a few different types of bubble. There are full market bubbles, as we saw with the Nasdaq earlier. You can also get a specific asset sector bubble, such as the housing market in 2008. There are then credit bubbles, which occur when loans and debt become out of hand, resulting in a wave of defaults. Lastly, an individual asset bubble, which can occur in any specific asset, such as we saw in Bitcoin in 2021. I hope this has helped you to get a basic understanding of what economic bubbles are. If there are other videos you want to see in future, please comment below and subscribe so you don't miss out. Have a great day!